Hey everyone and welcome back. It's been a while since I've looked at Alphabet Google in depth. I remember that way back when I started this channel, one of the very first companies that I analyzed was Alphabet, and I went through my process of analyzing a business and showed you how to do it way back when I was just starting out my channel. But really, I haven't touched on Google in depth in a very long time. I've spoken about it here and there in terms of earnings reports and that sort of thing, but I haven't done a full analysis. So that is what today's video is going to be. I'm going to go and break down, go into a deep dive into Alphabet, which is Google, of course, and go through the normal analysis process that I normally go through, which is we start by looking at the company itself, we look at its industry, its competition, that sort of thing. We call this expanding our circle of competence, or starting to identify whether or not Google could be within our circle of competence, a business that we could understand. Then we go ahead and look at economic moat analysis, looking to see if Google has any kind of unique competitive advantage over other companies that it's competing against. Then we look at management in a number of different ways to ensure that management are making the best decisions for us as shareholders. And of course, towards the end, we need to do an intrinsic valuation. We need to calculate exactly how much cash we expect to be able to get out of this investment over the next 10 or more years, and therefore, how much should we be willing to pay for it. So that is what we're going to do in today's video. If you do enjoy it and you want to see more videos like this, then consider becoming a subscriber, and if you don't want to, then just leave a like, drop a comment, do something that is interactive within the video, because apparently that's what YouTube likes. But yeah, if you want to show some support, you can do that in a number of different ways. But let's just get straight into the video, and let's start by looking at Google, its business itself. Many of you would know Google for some of its products, but overall, what does Google do as a business? So most of you would know Alphabet for its Google component of its business, which includes things such as their online services like their Google search, or YouTube is another business that is owned by Google, or you may know some of their physical products such as their phones, or maybe you're an internet marketer like myself and you know them for their core business, which is their advertising, which is how they gain revenue from free platforms such as YouTube and search. But Alphabet itself is also another business. Alphabet is Google, and it's also a non-Google component, which they call Other Bets. And this Other Bets component is very small. Most of Alphabet's income and revenue comes from their Google business, but they also have this smaller component, which is for their speculative investments. So they're investing in things such as autonomous driving and taxi fleets, and there's a bunch of other things that they're trying out that are most likely going to not generate any substantial amount of revenue, but every now and then one of those smaller bets becomes a big part of the Alphabet business, and then ultimately part of the Google business. And one of those smaller bets was YouTube. Google acquired YouTube for about $1 billion back in the day, and since then it's grown into a massive platform that generates a huge amount of revenue for Google and then for Alphabet. So that is essentially what Google's business is, Alphabet's business is, and as I explained briefly, the core of their business behind those products and services that they sell, while they do sell some phones and some hardware, and they sell Google Cloud, most of their revenue is generated from advertising. So they have free platforms such as Google Search or YouTube, and people want to post ads in front of people who are viewing content on those websites. And if we take a look at the global online advertising industry, the industry that Google generates most of its revenue from, you can see that it is still growing at a substantial rate. In 2018, display ads grew at 12.2%, online video grew at 28%, social media at 22%, paid ads at under 10%, and classified at 7%. So paid search, display, and video ads are the core of Google's business through their Google search and YouTube. And these areas are still growing at double digits, most of them at least. And they're expected to continue to grow at substantially high rates, at least for the next few years. So the industry is expanding, which means that if Google is going to increase their revenues, they don't really need to increase their market share. They don't need to take market share from other advertisers in order to grow at double digits. However, they are taking market share from other advertisers, and for the most part, it's from advertisers that are not online. So they're taking market share from television, from radio ads, and from physical ads such as billboards. And this is how they're continuing to grow at such a huge rate. So now I just want to zoom in on one key business indicator that you need to understand if you're going to be investing in Google, or for that matter, anyone in the online advertising space. So I have these things that are called key business indicators, and these are things that you need to be focusing on when you're looking at specific businesses. So these are going to be unique. While we can look at the revenue and the income for most businesses broadly, when it comes to specific businesses, there are certain key metrics that we need to watch in order to understand the performance of a business over time. One of the key business indicators for Google is cost per click, and this is defined as click-driven revenues divided by the total number of paid clicks and represents the average amount that advertisers were charged for each engagement by users. So every time that someone clicks on an advertiser's ad, how much is that advertiser paying Google? And this is super important because at the moment, online ads are very cheap per click. Their cost per click is very low relative to other things such as TV advertising. And for that reason, it is a lot more attractive for newer businesses and businesses that are looking to expand their advertising than continuing to spend more money on TV. And that gives online advertisers that are already established, such as Google or such as Facebook, for example, a huge advantage over these other businesses. By the way, guys, if you're interested in learning more about the 4-step process that I'm using in this video to analyze businesses and that I use to consistently find low risk, high return investments, then you may want to check out a free 20-minute training that I put together on my website. It also includes not only the 4-step process, but also some of the major beginner mistakes that I see investors making in the stock market. So if you're interested in checking that out after this video, then please go ahead and check the first link in the description below. But moving on, let's have a look at economic moat and start to analyze whether or not Google or Alphabet has a long-term competitive advantage over other companies in its industry. Now, from a basic understanding of Google, it's pretty obvious that they do have some kind of intrinsic advantage or multiple intrinsic advantages that give them an advantage over their competitors. And we could dive a little bit deeper into this, but to give you an example of one of them may be the networking effect. So on their YouTube platform, the reason why it's so successful is because it's got the most amount of users uploading content and people watching content. And what that means is that anyone who's a viewer who wants to find out something in video form, they're going straight to YouTube. And for that same reason, if you're a content creator like myself, you're going to be uploading content to the biggest platform. And that results in one company, one platform dominating over other platforms. And there's really no competitor to YouTube. There's no one anywhere near YouTube. And the same has happened with Facebook and social media. There is no one near Facebook because it's the go-to and it has that networking effect. So that's one example of how we can qualitatively identify an economic moat within the business. But then, of course, we need to go ahead and make sure that it's backed up in the numbers, because every good business that does have an intrinsic layer of protection will be consistently growing their business over the very long term. They'll be consistently bringing in more customers and taking market share from other businesses. As you can see, Google's business has been growing at an exceptional rate. Their sales have been growing at 20 to 23%. Earnings per share has been growing between 10 and 18%. Equity has been hovering around that 15 to 20% range. And free cash flow has been pretty consistently growing at about 10 to 15% besides the latest year. So what those numbers show us is that Alphabet clearly has some kind of competitive advantage over the other businesses in the advertising industry. And that gives us confidence that when we're going to be projecting the future cash flows of this business, we can be confident that they're going to continue at somewhat in the same pace as they have in the past. And when we're being conservative, we're going to be using a little bit lower numbers, of course. We can be very confident that those conservative numbers are very achievable for a company like Google, and that they're going to be consistently outperforming for the next 10 years because they will still have those major competitive advantages. The next part of our 4-step analysis is to look at management, and we look at management in a number of different ways. We look at their integrity to shareholders, whether or not they're being honest and transparent. We look at their skill at investing, how effective are their investments and what return are they generating on those investments. And we look at the debt, making sure that they don't have too much debt that's going to hurt us in the long run. But in the interest of time, we'll just zoom in on return on invested capital and have a look at how effective their internal investments have been over the past few years. As you can see, Google's return on invested capital has been above 10% in almost every year for the past 10 years, or since 2006, past 12 years. However, it has been declining. So we generally want to see that there's a positive trend. However, with a company that is growing as quickly as this, and that is as new as Google, this is not to be unexpected. This is pretty standard for a company that's brand new. I think they went public back in 2004 or something like that. But what we would want to focus on is the short-term trend. And you can see that from about 2014 till now, their ROIC has been very consistent. It's been sitting around that 15% range, which is a great rate, and it's also very consistent. And actually in 2019, it was all the way up almost at 20%, which is an excellent sign. So those ROIC numbers tell us that Google is consistently able to invest more money and generate a huge return on it. In 2019, they had a return on invested capital of around 18%, which means that for every additional dollar that they invested, they generated 18 cents in profit, which is excellent. That's really high, and we're generally looking for this to be consistently above 10%. And if it is consistently above 10%, then it means that we can be confident that they're going to be able to reinvest their profits and grow their profits consistently over the long term. And that, again, like the economic moat, gives us confidence that when we're projecting cash flows into the future, that our projections are likely going to be accurate. And then finally, of course, we have to do an intrinsic valuation. And when we're doing an intrinsic valuation, what we're doing is we're calculating how much cash we can expect to get back from this company over the next 10 years and beyond, and therefore put a price on how much we're willing to pay for that. Because, of course, companies are going to produce a finite amount of profit. The amount of profit that they're going to produce is limited. So our price that we're willing to pay for the company should also be limited. And we can do this by doing a discounted cash flow, where we estimate how quickly cash flows can grow into the future and therefore come up with a discounted cash flow, a value of intrinsic value for this company today, and therefore how much we should be willing to pay for it. Now, there's a number of different ways that we can come up with this growth rate. And usually what I like to do is I like to pick a few different growth rates so that I can get a range at which intrinsic value is likely to sit. And that will give me confidence that I'm not going to be using one particular growth rate and overestimating a company's potential. So what I would normally do is I would do a range. But for the sake of time in this video, we're just going to zoom in on one model and show you what the outcome of that model would be if we used certain growth rates and that sort of thing. So the growth rate that I'm going to use is 11.6% per year for the next 10 years. And the reason that I've come up with that is because that is the historical free cash flow growth rate for Google over the past 10 years. So I'm assuming that they can continue to grow their free cash flow at the same rate that they did over the past 10 years. So if we use a growth rate of 11.6% and we're growing their free cash flow, which was in 2018, $34 billion, and we're using a discount rate of 3%, which is the current, it's about the current 10-year treasury yield, which is the risk-free return that we could expect to get. What we come up with is an intrinsic value of just under 1.3 trillion for the entire company. Now, that sounds like a lot, but the intrinsic value is not how much we're willing to pay. So to work out how much we're willing to pay, we need to discount it at our required rate of return. So if we were to discount it at 15%, so no margin of safety, but we're looking to get a 15% rate of return, then the price that we get is $508 billion for the entire company. So the current market capitalization of the business is about $720 billion. So even looking at a 15% return with no margin of safety, it is still overvalued. And if we included another 50% margin of safety in that price, meaning we take the discount rate to 22%, then we would be looking to buy it at about $330 billion for the entire company. So in other words, if you're looking to make a 15% return and you want a 50% margin of safety for errors in our valuation, and you were using an 11.6% growth rate for their cash flows, then you would be willing to pay about a little bit under half of what the current stock price is. Now, of course, you could pay more than that, but if you paid, as we said earlier, if you paid 500 billion for the whole company and they perform as we expect, you'll make 15%. But if they don't perform as we expect, then you won't make your required return. And that is why we need to allow for that margin of safety, because we need to understand that we're not always going to be accurate in our valuations. And we need to allow for the fact that we could make a mistake. And by having that margin of safety, we limit our downside in these kinds of investments and we maximize the upside potential. So I hope you guys enjoyed this analysis of Google, and if you did, make sure you leave a like and let me know your thoughts down in the comment section below. Of course, if you're new around here, please consider becoming a subscriber. I'm making these analysis videos every single week going forward now, and I also bring out a bunch of other stock market related videos. And of course, as I said halfway through the video, if you're interested in learning more about this 4-step process, then I did put together a 20-minute training video on my website, which you can get access to via the first link in the description below. So go check that out if you're interested. But for now, guys, I'll see you in the next video.